Coming up today, the S&P hits a new record as Oracle stock gains 36%. Is Apple a buy the dip? Wholesale inflation declines. CPI up on deck tomorrow. Will economic distress hit the stock market? The latest hot IPO. And say hello to the world's richest man now. It's another big day, guys. Let's go. And once again, we've got some mixed price action in the market. Bunch of sectors and stocks going up, and quite a few others going down, even in mega cap tech land. Saw Amazon and Apple come off a bit today. But once again, it was the AI trade absolutely lighting up thanks to Oracle. And that's the market re-rating their shares on the back of their guidance yesterday of a huge backlog and projected revenue for their cloud infrastructure over the next 5 years. And that's thanks to ChatGPT maker OpenAI signing a massive $300 billion deal with Oracle. And that's where the majority of that projected revenue is going to come from. And so basically, ChatGPT is turning to Oracle to help power their chatbot. And so, of course, Oracle's growth is now tied to ChatGPT's growth. And this is one of the largest cloud contracts ever signed. We're spending on AI data centers hitting new highs despite mounting concerns over a potential bubble. And that caused a massive spike in Oracle shares today. Up 36%, adding $244 billion in market cap, having its best day since 1992. And now making Larry Ellison, founder and chairman of Oracle, the world's richest man for the first time, overtaking his buddy Elon Musk, drawing comparisons to a repeat of 1999. Larry and Oracle were a big hit in the internet boom back in the 90s. But fundamentally speaking, at least I don't think we're at the peak. Just looking at the supply and demand dynamics. With data centers, the vacancy rates in North America have fallen to a record low, 2.3%. Any available compute power is getting quickly snapped up. And I agree with this post on X from the AI investor. AWS, Amazon's cloud service, widely considered the largest and most oldest cloud service, has an annualized revenue run rate of around 123 billion. Out of nowhere, Oracle Cloud has guided to surpass that in just a few years. AI demand is insane. It's shaping up to be bigger than any tech wave we've ever seen. And that's why I still think there's many more years to go in this AI boom. Looking back at past technological innovations, they do help to unlock productivity gain, allowing us to do more with less. Obviously, electricity was a big one. Computers in the 90s, going into the 2000s, and I think AI could very well challenge that of electricity in terms of productivity gains. And the market seemingly agrees today, defending this monster gap up in one of the largest stocks in the market, Oracle, now almost on its way to $1 trillion in market cap after announcing that monster $300 billion deal. Its AI-driven backlog exploded to $455 billion, giving the market multi-year revenue visibility, reiterating the huge boom in CapEx and just reflecting a massive scale-up in AI cloud adoption. And that sentiment spilled over across the entire industry. Broadcom just coming off the back of a strong quarter itself with AI revenue beating estimates. It too's got a standalone $110 billion backlog showing sustained demand across enterprise AI. And the market's once again running up Broadcom shares. Some even saying it's the only real challenger to NVIDIA in the custom AI chip arena. But I'd say Google's TPUs and AMD will continue to play a strong role, and it actually benefits them as well because all these data centers need GPUs to run on top of. And that's why we saw NVIDIA up almost 4% today as well, as they too stand to benefit from this increased spending. And we've got a whole bunch of smaller AI-related names up big today like CoreWeave, which NVIDIA actually owns a part of, and Taiwan Semi as well, also breaking out to brand new all-time highs. And I think by extension, this should also cause a repricing for the number one commodity that's going to power AI, uranium, with the World Nuclear Association saying that demand for uranium is forecast to rise by nearly a third by 2030 and to more than double by 2040. And I think that's been quite conservative. With one uranium company CEO saying there's momentum in the industry which we have not seen for decades. And we just saw the Global X uranium ETF just break out to new multi-year highs today and going out to a monthly chart looking pretty solid here as it appears to be in the midst of a strong bull market. Uranium miners as well, looking pretty good on the chart, and they too, on the monthly chart, could very well be testing these multi-year highs soon. Tesla could also be on the cusp of breaking out after earlier this week unveiling important new products that potentially represent a game changer for the company's energy storage business. That's the Megapack 3 and Megablock. Megapacks are Tesla's battery-based utility-scale energy storage platform. And that's a big challenge with solar and wind energy, is actually storing it. As unlike uranium, which is always on, the sun and the wind are not. And so Tesla batteries can essentially turn wind and solar power into more reliable power by storing energy. And so the new Megablock is a pre-engineered system that integrates batteries, switch gears, and transformers into one system, resulting in big efficiency gains. And this is largely an undiscussed part of Tesla's business, even though it's already generating over 11 billion in the past 12 months. That's up 43% year over year. And that's about 12% of Tesla's total sales. What's holding it back a little bit is the 7% decline year over year in EV delivery. But I think that's going to take more and more of a backseat as the robo-taxi and optimist bot come into the spotlight. With the stock still consolidating at this multi-month resistance zone, which is around 360 a share. Just moving on to Apple. After they just launched their latest iPhone and product upgrades, the market's given them quite a cold response due to underwhelming new features, potentially igniting fears of a weak upgrade cycle. However, that's not all unusual. As one analyst notes, Apple stock has typically been flat on iPhone announcement days and drops an average of 2% between announcement and release. But Wall Street's not given up, some even raising their price targets. And that's because the new iPhones set the stage for further innovation down the road. But the market once again sold them off today, pretty heavy, down 3.2%. However, I'd say it could be setting up for a buy the dip opportunity, potentially around its 200-day moving average here at 220, just because of its potential to partner more closely with Alphabet Google. And Tim Cook usually does a good job of listening to the market. So if he continues to see weakness in the stock price, I think he'll respond with what's needed, as they're still yet to make a solid recovery to all-time highs like the Nasdaq. Just moving on to the other big headline we got out today, wholesale inflation, the producer price index, which measures cost inputs across a wide range of goods and services, actually fell. Economists were expecting it to go up 0.3% month over month. We actually got a little deflation in it, down 0.1%. No doubt helping the chances for an interest rate cut come next Wednesday. And once again, we're yet to see tariffs show up in the hard data, with the year-over-year growth coming in lower than expected as well, 2.6%. Well below what economists were expecting at 3.3%. Once again, catching them off guard. This goes to show how hard it is to forecast, with these guys sitting there all day looking at it with comprehensive data models and other forecasting methods. They were well off, because like CNBC host Sarah Eisen said, it may just be the tariff inflation everyone was so worried about is just not materializing. And so will we get a similar print tomorrow with consumer price index, CPI? That's the last big data print the Fed's waiting to see before they decide what to do next Wednesday. Still possible that it comes in hot, because what's going on in wholesale inflation today bodes well for consumer prices over the coming months, the biggest input into them. So economists are expecting the annual headline CPI to come in at 2.9% year over year tomorrow for the month of August. That'll be up from 2.7 in July. And just looking at Truflation's forecast for tomorrow, they think it's going to come in a touch lower at 2.8%, with the biggest contributors coming from food, utilities, health, and household durables, whilst housing, transportation, and communications continue to deflate. And there's a look at the current hard data for CPI, where we've pretty much been tracking sideways this year. And so let's see what print we get first thing tomorrow morning before the market opens. Because as of right now, Fed Fund futures think there's a 92% chance the Fed is going to go ahead with a 25 basis point cut next week. Still giving some odds to a 50 basis point cut. I'd say if CPI came in at 2.7 or below, we could very well get a 50 basis point cut, as the Fed may look to get ahead of a quickly weakening jobs market, which could already be in a contraction. However, option dealers are not pricing in fireworks for tomorrow, so it would be a big surprise and upset if CPI did come in on a 3 handle, with the VIX one day at 13.3. That's the market implying the S&P 500 should move by less than 1% tomorrow, up or down. And just looking at the S&P 500 cash index, actually made new highs today with a record close at 65.32, as the overall setup does remain mostly bullish. And so that's kind of going to be the theme, I'd say, for the remainder of the year. Got these signs of economic distress mounting. The jobs market, consumer sentiment really low. A lot of people worried about the future. Fears of inflation coming from tariffs. Many investors calling the stock market an AI bubble, with traditional measures of valuation at record highs. And we did just have a record downward revision in the jobs market. Almost 1 million less jobs than what was previously reported. And that actually takes out the record from 2009 after a global financial crisis. And if inflation did come in hot, that would really surprise the bond market as well. Seen a sharp fall in yields over the last couple of weeks. 354 on the 2-year, and even getting down to a low 4 handle on the 10-year, potentially testing those lows from early April. And this could be the bond market potentially pricing in weaker economic growth ahead, maybe getting a bit worried about what's happening in the jobs market, as that typically does cause a contraction in the economy. But for the here and now, we still have plenty of technical momentum in the stock market, with one hot IPO after another, listing onto the stock exchanges, the latest being Klarna, the buy now, pay later platform, getting a warm response from investors today. The fintech coming out of Sweden spiked more than 30% above its IPO price on its first day of trading today, closing at $45 a share. And that may have helped the entrepreneur shares private public crossover ETF have a little bump up today, significantly outperforming the market, along with its biggest holding, NVDA, also having a good pop. And the entire IPO sector, looking at the IPO ETF, getting a lot of volume of late, with it too having a strong day, up 2.38%. And that owns shares and recently new companies to come to the market over the last year or so, but it is quite concentrated, almost 3/4 of the fund in the top 10. And in fact, its top 2 positions in Astera Labs and Reddit make up 30% of the fund. And another interesting ETF I wanted to profile today, the Invesco Buyback Achievers ETF under ticker symbol PKW. It's actually been a great long-term performer. Just going out to the monthly chart here. It's actually an old ETF coming onto the market in late 2006 and just overlaying the chart with S&P 500 SPY ETF. The Buyback Achievers ETF has actually outperformed by about 62% in that time. And so how this ETF works is it holds stocks and firms that have purchased significant chunks of their own stock, companies that are buying back their own shares. The idea is simple. A firm's own managers know the best valuation of its stock, and if it's undervalued, they'll buy it up, assuming they have the cash. And again, this fund isn't filled with mega cap tech, quite the contrary. Its largest position is actually in Chevron, oil producer, which you can see in my shareholder yield indicator, with me being the first to bring this indicator to the TradingView platform. And that's basically a modern day way to look at what the company returns to shareholders. It adds up the dividend yield, the buyback yield, so how many shares are being bought back per year as a percentage of its register, and also the debt paydown yield, how much of its debt is being paid back. And that's something more and more investment professionals are relying on when it comes to analyzing a stock instead of just the dividend yield. You also want to take into account how much of a company's shares is it buying back, and of course debt, because if a company's just issuing a lot of debt, then buying back shares and paying out dividends, that's not really giving you the true picture. And so that's why I prefer to use shareholder yield. And another stock held in the Buyback Achievers ETF that has a high shareholder yield, PayPal, something you don't normally see for a tech stock, with its shareholder yield coming in at a very healthy 6.45%. And so I find it quite remarkable that this ETF has outperformed the S&P 500 over the last almost 20 years, considering how well the S&P 500 has done, being leveraged to mega cap tech. And even though this ETF has outperformed the SPY over that time, it's still quite small at only $1.5 billion assets under management. And you compare that to the SPY, over $650 billion assets under management. And just looking at a few other ETFs performing well today and of late, this one's actually in my new ETF portfolio that I'm currently running as a model on US listed ETFs. The iShares Global Silver Miners ETF, SLVP, ripping up there today to multi-year highs on increasing participation, really strong price action, and again, a small ETF, not even $500 million assets under management. Given exposure to 31 global silver mining companies. Another one of the best performing ETFs today that could gain traction, the iShares AI Innovation and Tech ETF. Got a unique ranking methodology focusing on the most innovative companies in the AI space, up almost 4% today. As like I said, that AI infrastructure trade has been put back on. Another one performing today, the Van Eyck Digital Transformation ETF, up 3.64% on big volume. And this fund offers a pure play exposure to companies leading the digital transformation of the economy through digital assets without geo constraints, focusing on digital asset exchanges, payment gateways, miners, equipment, technology, service providers, digital asset infrastructure businesses, and e-commerce. And so I've seen the crypto miners have a really good week so far, as a lot of them are realizing with all their compute power they've got to mine crypto, they can actually rent it out to those looking for compute power. With what I'd say the leader of that business model, Iron, buying up thousands of NVIDIA GPUs, running them really cheaply with renewable energy, locations around the world, and renting out that compute power, which makes them kind of GPU landlords. Company's already profitable, coming in with a monster blowout in their most recent quarter, and that's great news because they can self-finance their growth. And it also helps, we got a little perk up with Bitcoin today, trying to reclaim its 50-day VWAP here. That no doubt helps the miners. And just looking at some other commodities, we've got gold still walking the line here. Silver shaping up once again on the chart with a technical bull flag formation, and crude oil still trading a little lackluster in the low 60s per barrel. And there's a look at the Russell 2000 small cap index, still consolidating below all-time highs. But like I said, the market's not really expecting fireworks tomorrow. So if we did get a hot CPI print, I would expect the market to pull back Otherwise, if it did indeed even come in line with expectations at 2.9 or even better at 2.8, very well could propel a rally as it kind of just cements the Fed can start cutting rates again. Because even though they would prefer inflation to be closer to 2%, it's the jobs market that is of more importance and helping all those struggling consumers, with many of them having lost their job. So we'll see what we get on that print tomorrow, along with the latest consumer sentiment reading on Friday, and that could really help set the tone going into next week's Fed decision on Wednesday. And that's a wrap for the daily market review today, guys. Thanks very much for tuning in and supporting this channel. My name's Jared, and I'll be back again this time tomorrow to break it all down for you once again. Cheers.